Good evening, attendees of this third Reset webinar with the distinguished Professor Ross Garnaut. Welcome back to those of you who have attended one or both of the last two lectures, and welcome to those of you who are attending this lecture series for the first time. I am Abigail Payne, the Ronald Henderson Professor and Director of the Melbourne Institute, Applied Economic and Social Research in the Faculty of Business and Economics. Let me acknowledge the traditional custodians of the country throughout Australia and their connections to land, sea, and community. I pay my respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. Please also join me in extending a special welcome to our deans and deputy deans, our business and economics board members, alumni council members, and young alumni committee members. Last week, we learned about the historic Tree of Knowledge in Queensland, and Ross walked us through a thorough explanation for why he believes a return to the dog days is not possible. Key to his analysis were considerations that included our increasing public debt, lower growth in the labor force, reduced gains from trade and capital stock, and lower productivity. Ross, however, left us with a spirit of optimism that we can end up in a better place than we were in during the recent dog days period. For those of you who are new to this lecture series, Professor Ross Garnaut is highly regarded in Australia for the roles he has played to influence economic policy and international relations. Ross's long-standing career has encompassed a range of positions that have included policy advisor, diplomat, and businessman. It is with much delight that Ross is my colleague at the Melbourne Institute. Tonight's lecture focuses on Ross's optimistic predictions for Australia and what is needed to restore prosperity after we exit from this crisis. Please welcome Professor Ross Garnaut.
Thank you, Abigail, and welcome everyone. Welcome back, as Abigail said, for quite a few, and welcome anew for others. I said in the second lecture last week that we face a post-pandemic restoration of Australia, or post-pandemic dog days. In this lecture, I focus on what we must do to make restoration our path. We won't spend time on the worst possibilities. There's little enough time to explore what we can do to achieve the best that is possible. Carry on as we were, and shockingly bad outcomes will come without any directed effort from any of us. The Prime Minister last week in the National Press Club said he would lead a national discussion of reform. He would seek widely based community understanding and support for reforms that will not simply restore what we had before the pandemic recession, but lead us to a better place. That is the discussion we have to have. Last week, I mentioned an important development in the economy that we have to understand if we are to build a reform program for restoration. There's been a fundamental shift towards higher private savings and lower private investment that has greatly reduced real interest rates in global and Australian capital markets. And I'll just put up a couple of last week's charts as a reminder. First, a chart showing how dramatic and steady falls in interest rates. This is the 10-year bond in the Euro, Australia and the US. It's been proceeding right through this century. Bit of an acceleration during and immediately after the global financial crisis, but that's really a little blip on a strong downward trend. And today, last year and today, we've had rates a bit below 1% in the US and Australia and close to zero in Europe. And then just focusing on Australian bond rates, real and nominal. The blue lines are the 10-year bond, the orange line, the index bond rate. The difference between the two, expectations of inflation. Real interest rates have fallen from around their long-term historical average of around 5% to next to zero late last year and early this year. Picked up just a tiny bit through the pandemic anxieties. Real long-term interest rates set in capital markets are lower than they've ever been. This is a result of recipients of income wanting to save more than they and others want to invest at the old interest rates. Elsewhere, I have explained why I think that these are long-term and not transient developments in the world economy. In the contemporary world of surplus savings and low long-term market interest rates, new approaches to monetary and fiscal policy are required to achieve full employment in the developed countries. The short-term policy interest rates set by central banks have been kept near zero in most developed countries over the past decade. The Reserve Bank of Australia's setting of higher policy interest rates than other developed countries, albeit extremely low rates by historical standards, contributed to Australia's excessively low inflation, high unemployment and underemployment, and low growth in output per person through the dog days. One could argue that wages growth, inflation and employment would have been higher if fiscal policy had been easier, and that excessively tight budgets and not high policy interest rates were the problem. The Governor of the Reserve Bank has argued exactly that, calling for more expansionary fiscal policy in recent years. In my view, while governments could have done more to compensate for excessively tight monetary policy, the primary and greater error was the RBA's and not that of the Gillard, Rudd, Abbott, Turnbull and Morrison governments. The comparison with the US is instructive. I put up two charts in last week's lecture showing differences between the US and Australia in short-term interest rates and unemployment. US cash rates were consistently much lower until their unemployment fell well below ours a few years ago. The peak of the divergence was in the early dog days, when our dollar traded higher than the US for the first time for several decades. That dealt a heavy blow to many and a fatal blow to some large industries that are or would be highly competitive at today's exchange rates. It's a startling fact that Australian unemployment was higher in the middle dog days than in the depths of the GFC. During the early post-war decades, both the US and Australian economies were considered to be operating at or close to full employment. Australian unemployment was typically less than half the US. There is no obvious reason why the non-accelerating inflation rate of unemployment, NAIRU in the inelegant language of economists, there's no reason why the NAIRU today in Australia should be higher than in the US, when it was once consistently much lower than the US. Signs of upward pressure on wages and the price level in the US did not emerge until the massive Trump budget deficits took unemployment down to around 3.5% before the pandemic. The US NAIRU is now about 3.5%. The hypothesis that the Australian NAIRU now is no higher than that in the US receives some support from the regional variation in unemployment in pre-pandemic Australia. There were periods when unemployment was around 4% in Victoria and New South Wales without any sign of accelerating wage growth. Keeping money much tighter than the rest of the developed world may have held employment over the dog days to an average of several 100,000 people below what otherwise would have been possible. That would have cost us several tens of billions of dollars in economic output per annum, and a quarter to a third of that in increased public debt. The RBA has been changing its view about what rate of unemployment would correspond to full employment. A couple of years ago, the Reserve Bank Assistant Governor, Lucy Ellis, said in a public lecture at the University of Melbourne that it was about 4.5% and not a number beginning with the digit 5, which had been the Reserve Bank's position. Last week, in testimony to the Commonwealth Senate, the Governor of the RBA, Philip Lowe, said that the denudation of labour skills in recession may take the NAIRU back to 5. There is no reason to think that the number is at present is 5% any more than it's 3.5%. We simply don't know what it is and won't know until we get unemployment down to a level at which wages growth accelerates in the marketplace. The Reserve Bank in March reduced the cash rate to 0.25%, the lowest ever. It announced that it would buy enough government bonds to keep interest rates on securities of up to 3 years duration at 0.25%. It said that it would not change that stance until there is full employment and inflation is at target levels, and that it would not change the stance for several years. This is a big and good change. It moves monetary policy close to where it should be at this time. One caution, a bit more than a quibble. I would caution against holding rates above other developed countries when others go into negative territory, unless we are approaching full employment, and they are not. Monetary policy needs to be joined by sufficient fiscal expansion to remove unemployment in the shortest possible time. The emergency measures announced in March and April to support incomes and employment were a reasonable and timely step. The budget's contribution to demand will need to be maintained at this level for some time. The sooner fiscal stimulus can be shifted from incomes and employment support towards encouraging higher productivity and output, the sooner it will be possible to restore broadly based incomes growth. Last week, I concluded by putting up a chart just noting a number of elements of a full employment strategy over the next few years. And I'll just leave them there for a moment to remind ourselves of where we left off last week. And now I'd like to address the question, is government debt a constraint on growth and return to full employment? Because the strategy that I put up relies on quite a lot of increased budget debt over the next few years. How big would government deficits and debt have to be to increase demand enough to establish full employment? Can Australia afford it? How much government debt would be accumulated and how would that be repaid? And would all those deficits cause inflation? If there'd been no government fiscal response to the pandemic recession in March and April, this quarter's GDP, we're in June, and the March numbers came out today, but we're in June. This quarter's GDP would have been 15% or more, possibly much more, below the same quarter a year ago. We had unnecessary unemployment in 2019, so full employment would require increased demand to fill that gap as well. Some additional demand is also required to employ the increase in the labour force. So our starting point is a hole in the demand of well over 15% of GDP, or well over 300 billion. For the moment, JobSeeker, JobKeeper and other special measures are filling much of the hole. If JobKeeper and JobSeeker were wound up on schedule this September, how much new fiscal stimulus would need to be provided to keep us on a path to full employment by 2023? When there is unemployment, $1 billion of increase in the Commonwealth deficit can lead to much more than $1 billion increase in demand. The multiplier is greater the more expenditure is directed towards households with relatively low incomes. Judiciously allocated incentives to business investment may also have large multiplier effects, but will take time to respond strongly. The partial recovery of expenditure and incomes in restricted industries, as restrictions are eased, will have its own multiplier effect. The extent of recovery in the restricted industries depends on the progress of the pandemic and on behavioural responses to the legacy and the continuing presence of the disease. There is great uncertainty. Some elements of demand will continue to fall for some time. Construction, which was not a restricted industry, will fall for at least a year or so as existing work is completed and new orders diminished by recession. The effects of some regulatory and behavioural responses to the pandemic will be felt more heavily over time until a bottom is reached a year or so after the worst of the disease. Layoffs and salary reductions in university staff exemplify the lags. New housing will fall markedly in response to reduced immigration and population growth. New mining construction will be severely damaged by the falls in commodity prices, with gold and temporarily iron ore being exceptions. The downgrading of investment intentions in LNG is large. Investment in renewable energy at the peak in 2018 and early 2019 reached about 0.5% of GDP. Policy uncertainty had caused a fall before the pandemic. The fall has accelerated with the recessionary decline in wholesale electricity prices. Certainly in 2021 and probably 2022, these various influences will see construction well below 2019 levels, perhaps by several percent of GDP. So the positive effect of the lifting of pandemic restrictions on economic output, incomes and employment will be significantly offset by declines in dwelling and other construction. Private consumption will grow slowly for the foreseeable future beyond the brief recovery of some restrictive industries. If the September withdrawal of JobSeeker and JobKeeper is implemented as announced, their contribution to demand will need to be replaced by increased demand from other sources. New transfer payments to households, or direct government expenditure on infrastructure or services, or private investment. The JobSeeker and JobKeeper programs have had highly positive macroeconomic as well as welfare effects. However, they do not contribute to increases in productivity and therefore to the living standards that can be maintained in future. Better to shift to expenditures that not only contribute to current welfare, demand and employment, but also to the future standard of living as well. The balance of fiscal stimulus should shift as soon as possible to services like health and education that contribute directly to the standard of living, or to infrastructure that increases productivity or the quality of future lives, or to greater labour force participation, or to encouragement of other investment that increases future productivity. Unemployment will remain high at least for several years, so there will still be a need for higher expenditure than before the pandemic on income transfers to the unemployed and others in great need. Now is a good time for structural changes to personal taxation and social security, because any revenue cost in transition contributes to the necessary anti-recessionary stimulus to demand. Lecture 4 suggests a reshaping of the tax and social security framework that would provide high levels of early fiscal stimulus in a way that is automatically reduced as we move to full employment and higher incomes. There is no reason to expect private investment demand to bounce back in the absence of stimulatory changes in international demand for Australian goods and services or domestic economic policy. The spur to higher investment will not come from international opportunity. Global output is set to fall this year. Global recovery will be weak and slow. This puts downward pressure on nearly all commodity prices that are important to Australian exports. And just to remind ourselves of something that we went through last week in a chart from last week. On the right-hand side, you see commodity prices at the moment. 100, the index level 100 represents the average through 2019. All other commodities in the list, aluminium, natural gas linked to Brent crude oil, coal and wool are well below last year's levels. Iron ore's not. Iron ore's below the average of recent years, but is higher than the average for last year. And I've mentioned some of the special factors affecting iron ore in last week's lectures. The earlier lectures drew attention to the shift in the centre of gravity of the pandemic to developing countries other than China. These together are major Australian trading partners. They include the Southeast and South Asian countries, first of all Indonesia and India, on which Australian hopes for future trade expansion and diversification had been placed. China is by far our largest export market, and we're fortunate that this is the one large economy that will experience positive growth in the year ahead. Positive growth, but at the lowest rate in China since reform and opening to the outside world began 42 years ago. In any case, the deterioration of Sino-Australian bilateral relations will weigh on the gains from trade. Australia's caution in relation to Chinese trade and investment will itself inhibit old as well as new patterns of trade and specialisation with China. China's caution will cause it to reduce reliance on Australia in areas where this imposes low costs on the Chinese economy. These international developments present strong headwinds for restoration of Australia. Lecture 6 discusses how we might reduce their impact while securing as best we can security, sovereignty and other national objectives beyond prosperity. The main mechanism through which reductions in policy interest rates boost economic activity in Australia is a decline in the foreign exchange value of the Australian dollar. There is no such decline if all countries are loosening monetary policy at the same time. Other developed countries are doing as much to loosen monetary constraints on growth, and some much more. The Australian dollar has retraced most of the falls it experienced immediately after the easing of monetary policy in March. There have been large Australian dollar appreciations against developing countries that compete with Australia in commodity markets, for example, Brazil for iron ore and Indonesia for coal. This chart was prepared a few days ago. A higher point on one of the lines represents a weaker Australian dollar compared with the currency concerned. Brazil has had a huge depreciation this year. Again, the base is 2019, average is 100. We've had a small depreciation against other currencies, but we're rapidly losing that. You can see from what happened in the first couple of months of the year that we had a big depreciation against Indonesia, the United States, and the SDR, the average of all currencies. We've lost a fair bit of that, and in the last few days since the chart was prepared, there's been a substantial further appreciation of the Australian dollar. So the mechanism that was very important to Australian recovery from the big blows during the East Asian financial crisis, 97, 98, end of last century, and the global financial crisis, a big fall in the Australian dollar is not going to give us that boost this time. The fiscal deficits that are necessary to put us on a path to full employment will be smaller the more that policy stimulates private investment and so generates greater increases in demand for each dollar of public deficit. Greater private investment also contributes to productivity growth. In the next lecture, I'll suggest a corporate tax reform that would promote investment without increasing the burden on businesses operating in competitive markets, especially small businesses, or on working Australians. The proposed reform shifts the burden of taxation from companies which invest heavily in Australia towards companies for which rent is a major proportion of earnings and which are undertaking little new investment. The reform would lead to a substantial increase in the budget deficit in the early years when fiscal stimulus is required. The loss of revenue will be recouped in later years after the establishment of full employment. There is great uncertainty, but this year's budget deficit may be in the vicinity of $90 billion, a huge number, even after the downward adjustments to the cost of JobKeeper. The deficit will need to be twice that large or more next financial year, 2020-21, to avoid stepping over a demand cliff. If all went well, the deficit would conceivably step down a bit in 2021-22 and more in 22-23 to about $50 billion and falling in 23-24 if we have achieved full employment. 4 years of deficits up to 2022-23 would have accumulated to around $500 billion, or a quarter of current Australian GDP. This would raise Commonwealth net debt as a share of GDP to about 40 to 45%, more than twice as high as immediately before the pandemic, and 4 times as high as at the beginning of dog days in 2013. By 2023-24, with full employment, output growth at about 1.5% of GDP, and inflation at the top of the target range at 3%, a deficit of about $50 billion would stabilise debt as a share of GDP. Reductions in the deficit from that time would re-establish resilience against future shocks requiring expansionary responses. And let's keep in mind that it's a dangerous world in which we live in, and there are lots of shocks around. Preparing ourselves for the next one has to be one of the things that we do in restoration. $500 billion is a number that's almost beyond our imagination. Can we afford that increase in debt? These numbers are huge by recent Australian standards, but not by international or our own historical experience, or at least the shares of GDP are not. The ratios are much lower than the UK at most times since the Napoleonic Wars. They are only about half the US now, and less than after adding $500 billion, they'd only be about half what the US is now. and they're less than a third, these numbers in 2022-23, less than a third of the US in 4 years' time, according to the Congressional Budget Office. They're around half the weighted average for the developed countries before the pandemic. They are substantially lower than in Australia through the early years after World War II. At current interest rates, a debt of $500 billion would attract interest of about 0.25% of GDP. This is not a frightening number. Of course, at interest rates that were common in the last several decades of the 20th century, the interest burden on $500 billion of debt will be heavy. Is there a risk that we will be confronted by an early large increase in interest rates? There are global and Australian dimensions to that question. Globally, the forces holding market interest rates at unprecedentedly low levels are deeply rooted. These downward pressures on long-term interest rates will be reversed only by massive increases in public debt in the world as a whole. I would at once have dismissed such an outcome as almost impossibly unlikely through to the mid-2020s. As the public finances of the world's largest economy lurch out of control and increase from immense levels in the world's third largest economy, the odds have changed to merely unlikely. What if it happens? The unlikely sometimes happens. It would involve a global inflationary event that undermines stability everywhere. It will be less difficult for Australia than most developed countries, but there would be no safe ports in this cyclone. Is there a risk that global interest rates remain low, but rates required for Australia to place new debt rise to levels that are difficult to manage? Much of our debt is being placed in long bonds, so the increase in interest costs would come gradually. Australian bonds currently do not attract a risk discount below those of other developed countries, and the deficit profile anticipated over the next few years would not generate one. The Reserve Bank is now indirectly underwriting the cost of Commonwealth and much state debt through its on-market purchases of securities. Purchased $50 billion from the announcement that it was going to enter the market to do this up until early May. But it hasn't had to do much since then, as the market has accepted that the RBA has taken the risk out of bonds over the next few years. If the market knows that interest rates are not going to rise and bond prices fall because the Reserve Bank's going to stop them, and if they believe the Reserve Bank, then the market's happy to absorb greater quantities of bonds. Is it possible that the huge monetary expansion involved in Reserve Bank underwriting of Commonwealth debt would be inflationary? No, while there is unemployment and growth in output below the country's supply capacity. But yes, if public deficits funded by Reserve Bank monetary expansion continue beyond full employment, and the credit expansion that is already in the system is not withdrawn fast enough from that time. We are a long way from that now, but we should be aware of the risks that will be present when full employment has been achieved and wage and price inflation are emerging. There are advantages in reinforcing inflationary expectations around the 2 to 3% range that has been the target for 3 decades. It would help in holding inflationary expectations within reasonable limits if the RBA and the government were to agree now to interpret the target as a 2 to 3% range on average over a decade. This would rationalise the undershooting of the dog days, while avoiding excessive caution over inflation blocking achievement of full employment in the early 2020s. But we have to think about the long-term inflation risk, but the opposite problem is more likely, that Australia continues to undershoot the inflation and overshoot the unemployment target. A continuation of the stagnation of the dog days will leave us with a rising ratio of debt to GDP and gradually increasing vulnerability to the next big recessionary shock. Does high immigration make full employment harder? Immigration increases both supply and demand for labour. Immigration has pretty well stopped during the pandemic. Should it be resumed, and at what rate during restoration of Australia? Early in the Howard government, I prepared a paper for Immigration Minister Philip Ruddock comparing US and Australian immigration. and assessing the effects of each on wages and living standards of ordinary citizens. Examining the composition of immigration in the immediate past in both countries, I concluded that Australian immigration tended to raise and US immigration to lower the average wages of low-income established residents. The difference arose out of the much higher content of scarce and valuable skills in immigration into Australia. The comparison will look different today. The huge expansion of temporary immigration was advertised as focusing on skills, but in practice has changed the composition of immigration towards less valuable skills. The easy availability of temporary immigrants for a wide range of employments has held back growth of Australian wages in the 21st century. The sudden fall in immigration this year has had an accelerated effect on demand for housing and has disrupted related industries. These effects will work their ways painfully through the economy before health circumstances allow a resumption of substantial immigration at some time in 2021 at the earliest. These are complex matters that I will discuss at greater length in the book from the lecture series. In summary, I favour greatly increasing the skill requirements for temporary work permits, especially the successors to and variations on the 457 visa. The qualitative tests of skills have not worked as advertised and could usefully be replaced by a requirement that holders of the visas be paid at least average weekly earnings. Only people with skills of higher value than the Australian average would qualify. Social as well as economic considerations favour shifting the balance strongly towards permanent migration. I would favour holding net immigration through the decade ahead to about the proportions of the productivity boom, at about 0.5% per annum of the established population. Now, I'd like to illustrate the broad nature of some of the big choices that we face by reference to a diagram that was familiar to economic students of my generation. It was developed by ANU economist Trevor Swan and clarified and made available to the wider community of economists by our esteemed colleague at the University of Melbourne, Max Corden. And I'll put up on the screen something that's very familiar to people who did Economics 1 in Australia in the 60s, but probably less familiar today. In looking at the big macroeconomic choices, we can think of there being two broad levers over policy. One is competitiveness, got it there on the y-axis, the vertical axis, and the other is real domestic expenditure. We can, and there are, I've got a blue line sloping down there called FE, full employment. You can have full employment with varying competitiveness, various combinations of competitiveness and real domestic expenditure. The orange line rising with the label OB, optimal borrowing, can also be achieved with various combinations of competitiveness and real domestic expenditure. You can improve competitiveness by lowering wages, increasing productivity, or depreciating the exchange rate. You can increase real domestic expenditure by any of the macroeconomic measures that increase demand, or it might be increased by exogenous factors, for example, improvement of export prices flowing through to demand for Australian goods and services. The state of bliss is the point at which these intersect, because you have full employment and an optimal level of borrowing. Question of the optimal level of borrowing is a complex one, which again there'll be more about in the book from the series. But let's just have faith that there is such a concept that can be discussed meaningfully for the moment. And in the dog days, we were consistently running the economy in the mauve segment, B, where there's unemployment plus spare borrowing capacity. B1 would have been the state of bliss with competitiveness at C1 and expenditure at E1, but we've been running the economy in the mode sector B at DD, where to get to full employment and optimal borrowing patterns, we would need to expand domestic demand. What the pandemic has done is shifted us further away from that state of bliss by reducing expenditure. That's the gap, the reduced demand that we're seeking to fill as we move back towards full employment, towards B1. Now, in the next chart, same chart, but here I want to illustrate what happens if you get a fall in the terms of trade. And you saw from the earlier chart that we are getting a fall in our terms of trade from this pandemic. The fall in the terms of trade shifts the optimal borrowing line to the left, and it means that the state of bliss of full employment and optimal borrowing requires a combination of more competitiveness and lower real domestic expenditure. You get more competitiveness, as I said, through wage restraint or improvement of productivity or depreciation of the currency. And the relationship between depreciation of the currency and competitiveness is complex. It only becomes a real depreciation, a real improvement in competitiveness, if wages don't respond to higher prices that come about with depreciation. So the deterioration of the terms of trade generally requires a combination of improved competitiveness and reduction in real domestic expenditure. That's part of the challenge that we face in the period ahead. Now, there's all sorts of variations on the theme that you need to discuss in a comprehensive story, but I just look at one other variation in the next chart. And there, I look at what happens if you're able to fund increased expenditure by increasing expenditure funded by a tax on rent, which does not affect investment or real economic activity. Such an expansion of expenditure funded by a tax on rent expands the real domestic expenditure at the state of bliss and allows you to get away with less wage restraint than would otherwise be possible. But let's keep in mind that we start from a difficult position where we are going to have to have a lot of income and wage restraint, and it will be necessary to increase domestic expenditure. How much is needed and how much pulling in of our belts is necessary will depend a lot on such microeconomic factors as reform of the tax mix. So that's the broad shape of some of the choices that we face, and so I'll bring all of that together now and just talk about some of the big choices that we face, and I'll go into some of the microeconomic detail of that in the next two lectures. But to get to full employment, we are going to need, for a while, a very large increase in demand. Once we get a budget deficit down to about 50 billion, and I would hope to be there in 2023, 24 with full employment, with a budget deficit falling once we're continuing to grow at full employment. But a very large increase in demand from the Commonwealth budget deficit is going to be needed for some time. And in the next few lectures, I'll suggest a range of ways in which we can fill the very big demand hole that we have to fill if we're going to move to full employment. I'm going to suggest that judicious reform of personal tax and social security can make a very large contribution to demand early on in a way that's self-calibrating, that will reduce as we return to full employment. And we'll have the incidental advantage of substantial increase in incentives for labour force participation. The corporate tax reform that I'm going to suggest has the same shape, big demands early on the budget deficit, but self-correcting over time. We're going to need a large increase in public infrastructure expenditure, really as large as possible, if we can focus on those investments that increase productivity. And this is going to need to be a feature of our economy for some time. Better if we can calibrate it to levels of unemployment. There's a strong case for a permanent increase in expenditure on high-value public services, including health and education. We've had a big recent reminder of the importance of public health. As we've discussed, there's scope for funding the increase in the deficit by borrowing, and beyond the return to full employment, if it's necessary to pull back on demand and public borrowing, as it may very well be to avoid difficult outcomes, then it will be time to focus on increased tax on households through removal of anomalies in personal and indirect taxation. And in Lecture 5, we're talking about the big role that can be played by investment to build the low emissions economy out of which we can secure large economic advantage, as well as prepare ourselves for playing our full part in avoiding a global shock from another source. Just very briefly, getting to full employment is going to require a big focus on competitiveness. And the more we can do on productivity growth, the more we can ease on wage restraint, and the sooner we can get to full employment and real wage growth. And I suggest that fourth things are going to be very important in competitiveness: unambiguous commitment to free multilateral trade. That's been compromised a fair bit, both in rhetoric and in reality lately. All the things you can do to damage productivity growth, mucking around with open multilateral trade is probably the most powerful. Going to need, for competitiveness, a lot of wage restraint until the market is again raising wages with full employment. We're going to need cooperative flexibility in working arrangements. We're going to need corporate tax reform, supporting flexible business and innovation. A point I'll make strongly next week is that equity and perception of what we're doing is generating benefits for the whole economy that's equitably distributed is a precondition for reform and productivity growth. It's naive to think that you can have big structural change, you can get cooperation in the workplace in improving productivity, that you can get acceptance of policy change that requires decline in less productive industries, unless there's confidence that we are heading towards full employment, and unless there's confidence in the social safety net. And a few words on the growth path through restoration, the growth path we want to put ourselves on from 23 to 2030. It's not realistic to think that we'll be that our incomes will be growing as strongly as either the productivity boom period of the 90s or the resource boom period, 2002 to 2012. The economic conditions won't be there for that. But I think it is possible to build towards a a set of outcomes that do have full employment and allow a return to moderate growth in living standards. I'm suggesting that the suggestions on immigration lead to labour force and population growth around 1% per annum, with some improvement in labour force participation resulting from the tax and social security reform. Growth in the capital stock will decline. In fact, the capital stock may very well decline in the next couple of years, but it's realistic to think that we'll get back on a path of moderate growth. This is an area where we may do much better if policy is well set. Total factor productivity growth around 1.2% might be possible in these circumstances. That's more than dog days, significantly less than the productivity boom. We can't do all the reforms that gave us that productivity boom in the 90s again, because those have been done, although some, like open trade, have been partly compromised. So we can get a productivity boost by getting them back. That all would lead to per capita output growth, 1.4% per annum, a big improvement over the dog days, not quite as strong as in the productivity boom and the resources boom. And GDP growth about 2.4%. Not high by our standards, but because it's concentrated more on growth in per capita income and less on population growth, it would be more rewarding for Australians. I'll leave it there, Abigail, and answer questions.
Great, thank you, Ross. Now it's time for a couple questions. I have several to choose from. Let's first start. There seem to be a couple questions around thinking about what is happening in the U.S. So if you don't mind, I'm going to ask you a few of those. So given the U.S. Fed is now holding U.S. dollars $7 trillion on its balance sheet, what do you think is going to be the impact medium and long term on the global economy? And how will that also impact Australia?
Well, I mentioned in the lecture that I see a very big risk in the US fiscal position. There's a lot of risk in general in the US. I'm not sure that financial stability and inflation would be the first thing I'd worry about. But while there is high unemployment, as there is in the US, a stunning deterioration in the labour market in the last couple of months, and without the equivalent of our JobKeeper and JobSeeker programs. They've got programs, but nothing as large, and a stunning decline in employment. While you've got high unemployment, the Fed can create money, can support government spending by monetizing the deficit without inflationary consequences. The US is in a different position from the rest of the world too, because the rest of the world has got great faith in the US dollar, and foreigners are prepared to hold US dollars and to help in the funding of the US deficit, although a lot of the funding is being done directly by the Fed at the moment. If ever there were a collapse of international confidence in the US dollar, then you would have a position of extreme financial instability in the US, and there's no way you could have that instability in the US without it affecting everyone, including ourselves. But I think that big expansion of the Fed's balance sheet is not the thing to worry about in the US at the moment. Getting the economy going, halting the decline in employment is the priority. Many of the things I've said about Australia are relevant to the US as well. While you've got unemployment, you can fund a deficit through money creation without financial instability. The the big challenge there, as here, would come with a return to full employment, but I'm afraid that's even further away in the US than here.
So let's stick with the US for one more question before I move on to some others. The US president seems to be pushing getting the US economy going again, despite there being continued high numbers of COVID-19 cases and what's going on there. Whereas in contrast, Australia seems to be taking more of a slow and steady pace, both with respect to getting back the economy going again, as well as controlling the number of cases, COVID-19 cases. Given your assumption that we can get back to full employment by 2023, do you think the speed at which we get the economy going again is playing a major role?
Well, going from where we are to full employment in 2023 is quite an ask, and it's going to require a number of things to work together: the increase in demand, the improvements in competitiveness, and the improvements in competitiveness are easier said than done. But it's worth, the advantages of getting there are so big that it's worth thinking about what's involved, and that's the thinking that I've been contributing to. But comparing our situation with the US, I think the US faces a very large risk of outbreaks of the disease requiring or prompting restrictive responses that mean that the recovery from pandemic might be attenuated. Remember, as I said in the first lecture, it's not only regulatory responses to the pandemic, it's also behavioural. If suddenly you start getting a lot more cases of COVID-19 in a city that hasn't had many before, then people change their behaviour. They don't go out there, they don't spend at restaurants, they don't go to the theatre or the football. Even if the government is allowing that. So I think there's a lot of risk in the US approach to getting back to work. The risk, the greater, because they have a weak public health system and so aren't able to monitor and treat outbreaks of disease as they are identified.
Right. Okay, great. Thank you. So a lot of what you've been talking about is the fiscal response of the government and investment by the government. So I have a question is, how far do you think the government should be going? And the comparison is to Japan, where Japan's government has been stimulating its economy to the tune of up to 200% of GDP. Do you think Australia should consider such an approach if it's needed?
We're used to thinking of Japan as a bit of a basket case. I went through this last week, but Japan has underperformed in a lot of ways in the last 3 decades. But during the dog days, 2013 to 2020, per capita income growth in Japan was higher than in Australia. And it wouldn't have been if they had not had those big fiscal deficits. The thing driving those deficits in Japan is that Japanese private savings are huge, and although investment levels are not all that low, their domestic surplus of savings over investment are very large. And if you relied entirely on demand in the private sector for employment, you would have an underutilized economy, unnecessarily low rate of output and employment growth, and so those government deficits have been necessary to get that per capita income growth, not fantastic, but higher than Australia. Now the worry always was, and I used to worry about it myself, that once you get such very large increases in debt, that if there was a change in global financial markets and interest rates rose, so you'd have a horrible burden of paying interest and servicing the debt out of the budget. And certainly the Ministry of Finance in Japan's been worried about that for a long time. That was behind the Ministry of Finance pushing very hard, although it was very difficult politically, to get a GST. I remember Sakakibara, the Vice Minister for looking after budget policies, telling me once, this is a really hard thing, but we have to do it. I might have to sacrifice at least 3 prime ministers to get this reform through, and he did. But they got the reform through, and but each time they raised the value-added tax rate, it set back growth, and each time it wasn't enough to stop the ever-increasing growth in budget deficits. So there are some limits, as I mentioned in tonight's lecture. There's some rate of borrowing by the developed countries that does more than soak up the huge global surplus of private sector savings at the moment. But Japan, with 200% of GDP in public debt, has not reached it. And while I did worry about the burden on the budget, there are no signs for the foreseeable future of Japan having to pay more than approximately zero to service its public debt.
Okay, great, thank you. I have a couple folks asking for a clarifying answer to the question of what do you mean by tax on rent?
That's half of next week's lecture. But rent is earnings in excess of what is necessary to attract investment to some activity, and it's permanent and stable. It can exist because you're using a natural resource that others can't compete with because government's given you exclusive right to it. Or it can exist because you own a piece of land that's more valuable than other land. It can exist because you can control a market as a monopoly. When a high proportion of your income is rent, then your decisions on investment are not sensitive to the competitive price of capital in the same way as businesses that are operating in a competitive environment. I mentioned the great quote from Solow in his letter to Max Corden last week.
Yes.
That issue was taken up by the president of the American Economic Association in his presidential address last year, Blanchard, and I'll come back to it next week.
So I'm going to ask you one last question, and I suspect part of your answer is going to be stay tuned for next week or the following week. But the question is full employment where? Do you have any sense of the industries or a targeting of priorities to achieve full employment?
I think that we're better off to rely on general mechanisms, improving the competitiveness of industry through general mechanisms, getting the macro settings right. But I will be saying in Lecture 5 that there are extraordinary opportunities in the building of a zero emissions economy in Australia that with the right policy settings can happen in the marketplace without policy distortion. But that's Lecture 5. Okay.
Excellent. Okay, so we are out of time for tonight. So I'd like to thank you very much for yet another very good lecture. And for those of you who submitted questions that were left unanswered, we will endeavor to answer more of them in our follow-up email. So we've now had 3 informative and engaging lectures. I look forward to next week's lecture, which will be on June 10th, where Ross is going to discuss the importance of equity to support productivity-raising reform. So thank you very much, Ross, and I look forward to next week.
Okay. Thanks, Abigail. Bye.